Welcome everybody to Volatility Trading Strategies. So recently I had a very interesting exchange on Twitter. Essentially the person was saying something that I've heard stated a lot in the past, and that is that renting a home is basically like flushing money down the toilet, but buying a home is a great long-term investment. Now I'm not here to change anybody's mind, because the truth is a lot of people out there would be better off just taking out a mortgage and making those payments. But I'm the analytical type. So before we just dismiss renting outright, we should at least put some numbers to the page. And who knows, perhaps the conclusion might surprise you. So first I'll show you the mathematical difference between owning versus renting. And then after that, I'll give you 10 things to consider that might help steer you towards one or the other. So let's get into it. Now this rent versus own topic is very polarizing, and just making this video, I know I'm going to get people out there that say I'm wrong, or perhaps that I'm an idiot. You know, YouTube comment sections can be vicious. I'll have people tell me what a fantastic investment their home was for them. Other people will say that my numbers aren't representative of their local area. Yet other people will say that owning a home gives them a sense of security that renting just can't provide. In advance of all of these comments, yes, you're absolutely right. We all live in different cities around the world. We all have different goals and risk appetite. We have different incomes, tax situations, family structures. Also, this video is going to be viewed at different times during the economic cycle, which can change things as well. The variables are vast, and tweaking them by just a little bit can tip the scales one way or another. It's largely based on your personal situation. So bottom line, this is going to be a very generic, broad, law of large numbers type video. All I have to go by is averages, and I'll do my best. So what we're really trying to calculate here is what is the difference in net worth of a person who owns their home free and clear after taking out a 30-year mortgage versus a person who just rented and then invested the difference. Calculating the net worth of the homeowner is very easy. Let's assume they purchased a $500,000 home. According to the U.S. Census Bureau, over the last 60 years, the average home appreciated 5.4% annually. The inflation rate over that same time period was 4.5% annually. That means the real rate of home value appreciation in the United States over the last 60 years has been just 0.9% a year. This is something that's not very well understood, but it is very important. When your home value appreciates, sometimes very significantly over a 30-year period, the vast majority of that is just inflation. It's just the loss of purchasing power of the dollar. Sometimes I hear people say things like, well, I bought my home in such and such year for $200,000, and now it's worth $600,000. It's tripled in value. What a fantastic investment. Well, that sounds great. But in actual fact, it's the dollar that's depreciating, which then pushes asset prices higher. But the real value of the home has not grown very much. Long term, in the United States as well as in Canada where I live, home prices tend to outpace inflation by about 1% a year. That's pretty standard. But back to the example. Continuing on, we're also going to assume that there's no tax applied after 30 years if the owner decides to sell their house. Primary residence, tax-free. So even though nominally that home may be priced at about $2 million 30 years later, adjusting for inflation, the homeowner's net worth is still just $626,309. Now, calculating the renter's net worth after 30 years is a little more involved, as there's two factors here. First, the renter doesn't shell out any down payment money, so that can just begin to be invested immediately. Second, renters will be paying less per month than comparable owners, and that monthly savings can be invested along the way as well. So first, let's calculate the down payment amount. While some people might get away with a 5% down payment, others may require 15 or 20%, so I'm going to assume a 10% down payment. That makes the initial mortgage $450,000. Mortgage default insurance gets added to that automatically, bringing the amount borrowed to $465,000. But we're not done there, because there's plenty of extra fees when you buy a house. These are all ballpark numbers that will vary, but close enough. We've got property valuation, land transfer taxes can be expensive. There's a property survey, home inspection, legal fees, title insurance. It starts to add up, and the $50,000 down payment actually ends up being $61,200. Now let's calculate how much each of them pays every month. At the current rates, the homeowner has mortgage payments of $2,521. For property taxes, I've seen as low as 0.5%, but it can also approach 2% or more. So we'll use 1% a year here as the average, which is $416 a month. Add another $416, because even if you don't pay it out every month or every year, Home maintenance does cost roughly 1% a year in the long run, so we have to budget for that. And then we'll need homeowners insurance as well. Now, one area where the homeowner can save money is the interest portion of the mortgage as a tax write-off, and that can be several thousand a year, so we'll get some money back here. All in, the homeowner can expect to be shelling out about $3,023 a month. Now, obviously, rent is going to vary a lot depending on where it is. For today, I've checked current listings of 3 Canadian cities and 5 US cities to come up with the average of about $1,900 a month on a $500,000 home. Add in $35 for renter's insurance for a total monthly payment of $1,935. This means the renter will save $1,088 a month, which can be invested along the way. Now we've got both the input variables we need to calculate the renter's net worth after 30 years. The Vanguard VBinks, which is a 60% stocks, 40% bonds index fund, has returned 8.9% annually in the last 25 years. Now, just like with home appreciation, a large chunk of that return is just inflation, so we need to keep apples to apples comparison here. This brings the real rate of return to just 4.4% annually. Now, for the investor, we do also have to factor in capital gains taxes. In the US, it's pretty low, but there are countries like Canada where it's higher, so I'm going to use an average of 25% here. Most people will be well below this, and if you invest in a tax-sheltered account, IRAs and whatnot, that will help defer those taxes as well. But let's just use 25% tax on all capital gains. The down payment portion of $61,200, accounting for capital gains and adjusting for inflation, will appreciate to $107,948. The monthly savings portion of $1,088, again adjusted for inflation and backing out capital gains, it'll be worth $526,786. For a grand total, inflation-adjusted net worth after 30 years of $634,734. In our generic example, using real data, the renter's net worth actually comes out a little bit ahead of the homeowner. And this may surprise some of you, but that is the power of compound interest. Remember, not only does the renter start with a very sizable investment account because they can forego that big down payment, but they also get to add to it every month. If invested wisely, that does build to a very substantial amount of money, and in certain circumstances it can equal or even outpace the benefit of owning the home. Now here's where all those variables come into play, because they are vast, and changing the numbers by just a little bit here and there can really alter the conclusion. Now for me personally, it makes a lot more financial sense to rent. Because where I live in Vancouver, Canada, the rent-to-own ratio is terribly skewed in favor of renting. I live right near the seawall overlooking Stanley Park for a very reasonable amount. Buying this home would put my mortgage well over double what I'm paying to rent it. Another factor for me is that I make a far higher rate of return on my investments than our baseline index funds do. More than double, in fact, so for compounding purposes, the investments grow faster than the real estate. And I also like to have the freedom to move around if need be. Being mobile can really expand the scope of your employment choices, or in my case, entrepreneurial opportunities. Sometimes you have to move to chase the best option, but with homes, every time you do that, you get hit with all the costs. And now realtor costs on top of that, which could be in the 3 to 6% range, depending. Now again, I'm not trying to change anybody's opinion here, because for you it very well could be the other way around. But generally speaking, here's 10 baseline rules that you might want to consider. 1. Check the rent-to-own ratio in your area. If it is skewed towards cheap rent, then consider renting. If home ownership where you live is affordable, then maybe consider buying. 2. If you are planning on moving more than, say, once every 10 years or so, then renting will probably be better for you. If you don't anticipate leaving, then maybe throw down some roots and buy your home. 3. If you are a savvy investor and you can get more than 7% a year on your investments, then renting is going to be better in the long run. Now, this is a shameless plug, but check my website if you do need help with your investments. But if you're not an investor, then just buy your home. 4. If you're not a very disciplined saver, then just go ahead and buy your home. It's essentially a forced savings account. And when you rent, it actually does require you to take that money and put it to work in the markets. Without that, it just doesn't scale. 5. If interest rates are low and you anticipate them to stay that way, then buying does make sense. In a rising interest rate environment, however, those mortgage payments can increase substantially, so keep that in mind. 6. If home prices are at the high end of their value, then maybe consider renting until the next recession hits. Remember, when you're investing, there's always ways that you can short the market, but you can't short your home. And if you do get caught in a price collapse, then it could take a number of years to get back to fair value. 7. The more expensive the home is, typically the more skewed it is towards renting being cheaper. This is why a lot of rich people actually rent their homes. If you're talking about a multi-million-dollar home, renting is just going to be more efficient. Number 8, if you do need a large backyard, then consider buying your home. Of course, there are single-family homes out there for rent, but the supply is limited compared to apartments, which are very abundant. So the price of renting can skew to the high side. 9, if you are in a position to both buy a home and to invest as well, then consider renting where you live and buying an investment property to rent out to other people. This can really supercharge your investments, and it can be a very efficient way to utilize your capital. And lastly, number 10, if you are the type of person that really does need to own your home to have that feeling of financial security, then just go ahead and buy it. Financially, it's going to be pretty close either way, and you certainly don't want to lose sleep over this decision, so just buy your home. So that's it. Rent versus buy. It's certainly not as black and white as some people paint it out to be. Renting is certainly not flushing money down the toilet, and there are advantages to renting in certain situations. Having said that, a lot of people out there are just better off owning their home, but you do have to crunch the numbers for your personal situation. So if you have any questions about this video, maybe you want to bounce a few ideas off me, feel free to email me anytime. I'm always here to help. Thanks for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all of my trading strategies for a full month absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comment section below. See you next time.